I'm going to talk about your debt to income ratio and why it's important for you to know this before you apply for a home mortgage or even any other loan. This ratio, this number, is what lenders use to determine how much monthly debt you can handle without being a risk to them. And also, this will, with a good debt to income ratio, it offers you more money that you can borrow and also your rate that you're going to have. So how do I figure out my debt to income ratio? Very simple. Number one, you're going to add up all your monthly debt that appears on your credit report. Okay? So that's going to be like your rent or mortgage payment, your minimum credit card payments, not if you're paying extra on the credit card. You want the minimum payment that you're required to make every month. If you have a car loan, if you got student loans, and then anything else like child support or alimony. So you're going to add all of these up, and that is going to give you your monthly debt. Then you're going to look at your gross monthly income before taxes. So that's easy for you to do because you know how much you make every month. What you do to get the ratio, you take your, for example, let's say you've got $1,500 in a rent payment, you've got a $100 car loan, and when you added up all your credit card debt, you got $2,000. So $2,000 is your debt, and your gross monthly income is $6,000. So you take $2,000 divided by $6,000, and you get a debt to income ratio of 33%. Okay, what does that mean? Is that good or bad? Lenders are looking for a debt to income ratio below 36%. You can figure this out yourself. You can add up your monthly debt, and if it's too high, you're going to want to bring it down. Now, if you're in the throes of, we're applying right now for, a loan, talk to your lender about this, and they can help you decide what, what, I want to see you pay this off or do this or do that. And if you are high risk, if you have a lot of debt, it could be possible they'll suggest debt consolidation before you apply and do all that work with the lender to get a loan. So lenders work with people. A lot of times you don't do everything right away, but they will look at everything and they will help guide you in this. So what are some suggestions for you to do if you decide you have a high debt to income ratio, you're not ready to go and apply? I will tell you to take a look at your minimum payments. You want to get rid of some. So you might want to look at this one. It's a lower amount that you owe. Pay that off first, then pay the next one. You're going to figure out which ones you need to pay, and then you can recalculate your debt to income ratio and see if that's a better number or not. And second of all, you're not going to pull out any new line of credit because a lot of open lines of credit can affect, your lending possibility, especially when they're new. And then you might, like I said, you might want to try loan consolidation if you have extremely high debt and you really don't see your way out of it. I mean, yes, there's loans that are a little bit more high risk, but let's try to get our debt to income down because that's going to be better for you in the long run. Stay on budget. So if you have any questions about this, feel free to reach out to me. I'm here to help you, and I will see you on the next video.